Hello and welcome to Beyond the Charts, a show where we dive into fascinating charts from the world of finance and the economy, breaking down what's really going on. To view all the charts and sources discussed in this video, do check out our newsletter. You can find the link in the description. I'm your host Tarun. Let's get started. It's December, the time of the year when global research firms start rolling out their predictions and outlooks for the coming year. It's hard to predict what's in store for the future, and things don't always work the way we want. There's this saying by a famous baseball player, Yogi Berra, and I quote, "It's tough to make predictions, especially those about the future." Having said that, you can still find some useful data points and ideas from these reports. So we went through the outlooks from major investment banks, asset managers, and brokers to handpick the most interesting highlights. In this edition, we'll explore what analysts from these research firms are forecasting for 2025. Let's start with India. As we've discussed in recent episodes of Beyond the Charts, high-frequency indicators are signaling a slowdown in India's economic growth. This was further reflected in the September quarter's corporate earnings, where many companies reported weaker than expected results. It's no surprise then that India's GDP growth for the second quarter of FY 24-25 came in below estimates. That said, the bigger picture still looks promising. Analysts project India to remain the fastest growing major economy in 2025 with an estimated growth rate of 6.8%. That's not to say everything will be hunky-dory. Inflation has increased again in the last few months, mainly due to rising food prices, which have been impacted by weather-related disruptions and is expected to stay above the RBI's tolerance level of 4% in 2025 as well. According to research by DBS Bank, inflation is projected to average at 4.7% by the end of the current financial year and 4.1% in FY26. On the bright side, there's some good news when it comes to interest rates. DBS expects the RBI to begin cutting rates as early as February next year, with a potential cumulative reduction of up to 0.75% by the end of 2025, bringing the repo rate down from 6.5% to 5.75%. There are other concerns as well, such as potential tariffs from US President-elect Donald Trump. If such tariffs are imposed on Indian exports, it could put additional pressure on the Indian rupee, which has already been on a downward trend. If tariffs are imposed on Indian exports, DBS Bank projects that the Indian rupee could weaken further, reaching 86 rupees per dollar by the end of 2025. If you're wondering why tariffs on Indian exports might be on the table, there's a solid reason. The US trade deficit with India has grown significantly compared to where it was during Trump's first term. And this wouldn't be the first time Indian exports have faced tariffs. Back in 2018, the US imposed tariffs on steel and aluminium imports from India. In response, India retaliated by imposing tariffs on US agricultural products. Private capital expenditure in India has been inconsistent over the past few years. While FY 22-23 saw strong growth in private investments, this momentum stalled in FY 24, remaining largely flat. Moreover, the investments have been concentrated in just a few sectors. For India to sustain and accelerate economic growth, broader participation from the private sector is crucial, both in terms of scale and across a wider range of industries. Across the BSE 500 universe, 181 stocks are currently considered overvalued, a significant jump from just 79 stocks in January 2020. This sharp increase highlights the growing valuations in the Indian stock market over the past few years. At the sectoral level, consumer durables, infrastructure, telecom, and capital goods are trading significantly above their historical valuations. On the other hand, sectors like private banks and automobiles are trading below their historical valuations and have been doing so for an extended period. So whether something is overvalued or undervalued, it can remain in that state for a prolonged duration, often defying expectations. Despite concerns about overvaluations, India's equity landscape offers unique strengths. A standout factor is the high return on equity or ROE. Nearly one-third of Indian companies have an ROE of 20%, making it one of the most ROE-driven markets globally. For context, India's 10-year average ROE stands at 14%, which is better than peers like Mexico at 13% and China at 12%. Adding to this, India's market risk is relatively low. The one-year rolling beta of MSCI India against MSCI emerging markets has been declining, indicating reduced volatility and lower risk compared to other emerging markets. Now let's take a look at global economic forecast. The Economic Intelligence Unit or EIU projects global GDP growth to remain moderate at 2.6% in 2025, unchanged from 2024. Growth in the US is projected to moderate to 1.7% in 2025, reflecting a broader slowdown. However, consumer spending is expected to remain strong, supported by a resilient labor market and stable wage growth. Despite this, policy uncertainties under the Trump administration, such as potential tariff increases and stricter immigration reforms, pose risk to the US economy. For other advanced economies like Japan, Germany, and the UK, growth is anticipated to improve slightly compared to 2024, but will still lag behind the global average. Apart from India, China is the only major economy expected to grow significantly above the global average in 2025. Inflation has been a cause of concern for all economies. Inflation levels are expected to moderate to the central bank's target levels of around 2% for most advanced economies, providing more room for further interest rate cuts. While easing inflation might create room for rate cuts, interest rates are unlikely to return to pre-pandemic levels. Market expectations suggest that US interest rates will hover around 3.85% in 2025, with no significant reductions anticipated beyond that point. By the way, different central banks are taking different approaches to rate cuts. The euro area is expected to experience weak economic growth in 2025, driven by both internal and external challenges. Germany, the region's largest economy, continues to struggle with slowing industrial output and declining global competitiveness. Externally, China's economic slowdown and the potential imposition of the US tariffs on European goods add further pressure on trade and manufacturing sectors. In response to these challenges, the European Central Bank is expected to cut interest rates to around 2%, aiming to stimulate growth and support the region's fragile economic recovery. In the UK, persistent inflation and increased government spending are expected to lead a more gradual approach to the interest rate cuts by the Bank of England. Meanwhile, Japan is an outlier among developed countries. After years of ultra-loose monetary policy, the Bank of Japan is expected to continue raising rates, with projections suggesting an increase to 0.75% in 2025. Rising prices and political challenges have prompted this policy shift, marking a significant departure from Japan's long-term standing stance on interest rates. Coming to China, the economy is expected to grow at a decent rate, supported by recent stimulus measures aimed at stabilizing growth. However, these measures are unlikely to provide a significant boost to the overall economic trajectory, indicating that growth will remain steady but not spectacular. The Chinese economy is facing structural challenges such as slowdown in domestic consumption, deflationary pressures, and struggling real estate sector. To put this into perspective, despite lower mortgage rates, household borrowings has remained subdued, highlighting a lack of confidence among consumers. Focusing on risks, while inflation is currently easing, it still has the potential to resurface unexpectedly, posing a threat to the growth prospects. According to Invesco, there are a few key factors that could drive inflation higher. First, an uptick in US wages and the prices paid for services, which could fuel cost pressures. Second, rising shipping costs, which would increase expenses across global supply chains. That isn't the only risk. Donald Trump's proposed tariffs on exports from China and other countries could also disrupt global economic growth if implemented. According to Schwab's outlook, the US economy is expected to bear the brunt of these tariffs with a projected 0.4% hit to GDP growth. On a global scale, the impact is estimated to be smaller, around 0.1%. Trade restrictions are not a new phenomenon. They have gained a significant momentum since 2014 and have only escalated in recent years. Here's a useful chart from the IMF highlighting the biggest risks that could either negatively or positively impact the global economy. Let's start with the risks that could hurt the economic growth. Firstly, the ongoing crash in property prices and oversupply could drag down global growth and disrupt trade with cheaper exports flooding markets. Second, a sudden rise in unemployment in 2025 might slow the US economy and markets worldwide. Third, aggressive policy changes in the US could pull businesses out of Europe, hitting its economy hard. Fourth, an escalating trade battle between the US and Europe has the potential to disrupt global supply chains and weaken growth. And fifth, escalations in the Ukraine-Russia conflict or rising tensions in the Middle East and Asia could create significant economic uncertainty. On the upside, fresh stimulus from China could stabilize its property market, boosting confidence and growth in Asia. Second, a drop in core inflation across major economies would relieve pressure on central banks, creating room for growth. Third, a large-scale investment package in Europe could inject new life into the region's economy. Fourth, avoiding tariff standoffs and finding common ground would support global trade and business growth. Fifth, a Ukraine ceasefire, easing tensions in Middle East, and a progress on NATO and EU membership would bring much-needed geopolitical stability. Moving forward, a look at the debt levels of economies. Debt levels are climbing worldwide, with governments spending a larger share of GDP on servicing debt. Countries like Japan, the US, and Italy face the highest burdens, and the advanced economies are seeing sovereign debt ratios continues to rise. This growing debt burden limits resources for critical investments in areas like education and infrastructure, which are essential for long term. Additionally, excessive debt can fuel inflation if governments resort to risky fiscal policies. Over time, the high debt burden discourages business investments, slowing economic progress and making it harder for countries to sustain steady development. Now, let's focus on market performance. US markets have outperformed the rest of the world both in terms of returns and earnings by a wide margin since 2010, and it is expected to continue in 2025. Despite price to earnings, the PE ratio of US markets is well above the long-term average. There are expectations of a further 6% annual sales growth and an increase in profit margins due to AI adoption. The US markets are often seen as exceptional because they boast some of the strongest earnings growth, especially among the Magnificent Seven: Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta Platforms, and Tesla. On the other hand, when you look at Europe or other parts of the world, their profitability growth isn't that great. China's case is even worse. There's been a massive equity share dilution, which has kept returns for investors nearly flat. Add to that a struggling economy, and it's a no surprise the stock market has done nothing. A look at some interesting trends in financial markets. AI is expected to remain a major driver of IT spending globally, attracting significant investments, particularly in advanced economies. Private equity is quickly becoming a key funding source, with assets under management projected to nearly double by 2029, reflecting growing interest in alternative investments. Despite substantial investments in green energy, the global economy remains heavily reliant on fossil fuels. Renewable sources like wind and solar are growing, but will take time to significantly reduce this dependence. Global healthcare spending is expected to grow by 6% in 2025 as per EIU, outpacing inflation. This increase will be driven by public spending in developing countries and rising demand in aging populations across wealthier nations. By 2025, 12% of the global population will be aged 65 or older, a figure set to rise further. And that's it from us for this episode. If you have any feedback, please feel free to share them in the comments below and we will be happy to answer them.